Welcome back to the Pro Ticker Podcast, your Saturday morning edition covering major financial magazine headlines, everyone. You've handed us a really interesting stack of articles this week, and we're ready to dive in and extract some insights. Today, we're looking at a global snapshot, oil production, market trends, and even a dash of political intrigue. Get ready for some aha moments.
It's fascinating to see how these seemingly disparate pieces of financial news actually connect to paint a broader picture of what's happening in the world right now.
Okay, let's unpack this. First up from Barron's, we have AI could lift the oil industry's profits. It's happening in the Permian Basin now. AI transforming oil production. That's a headline that definitely caught my eye. I mean, when I think of oil fields, I picture roughnecks and heavy machinery, not algorithms and data analysis.
It's a really interesting shift. What we're seeing is that artificial intelligence is being integrated into the oil and gas industry in a big way, particularly when it comes to optimizing production and reducing costs. This Barron's article highlights how companies operating in the Permian Basin, one of the most prolific oil-producing regions in the U.S., are using AI to control machinery remotely, analyze geological data to pinpoint the best drilling locations, and even predict and prevent equipment failures.
So it's kind of like the semiconductor revolution, but for oil. Instead of silicon chips, we have algorithms making the decisions.
Exactly, and the potential impact is huge. The article mentions how AI is helping to lower break-even prices for oil producers, which is good news for companies like ExxonMobil and Chevron, especially in a world that's increasingly focused on renewable energy sources.
And those are companies that many of our listeners might have in their portfolio, so this is definitely relevant. So what does this mean for long-term energy investment? Is AI going to make oil a more attractive investment, or is this just a temporary boost before renewables take over?
That's the million-dollar question. On one hand, AI could extend the lifespan of oil as a viable energy source by making it cheaper and more efficient to produce. But on the other hand, the global push towards cleaner energy is undeniable. Investors need to weigh those factors carefully and consider how this technological shift might play out in the coming years.
It definitely adds a new layer of complexity to the energy investment landscape. Now, shifting gears a bit, let's talk about the global market roller coaster. We have a few articles here painting a rather mixed picture. CNBC tells us Asia markets live. Tokyo CPI, South Korean industrial production, shows a bit of a split. South Korea's industrial production is down, but Tokyo's inflation is heating up, potentially hinting at a Bank of Japan rate hike. And then there's the Wall Street Journal with Canada growth slows to 1% in third quarter. Canada's economy is cooling, and it makes you wonder, will the Bank of Canada cut interest rates again? And how much of this is tied to what's happening in the U.S.?
It's a fascinating juxtaposition, especially when you consider what's happening in the U.S. market. The Wall Street Journal also reported in their piece, S&P 500 Dow notch records to cap best month of the year, that the U.S. stock market is riding high, with both the S&P 500 and the Dow hitting record highs this month. It seems like a completely different world.
Right. And MarketWatch even went so far as to call it a red sweep in their article. Stocks ride a best month in a year as red sweep unleashes animal spirits, pointing out how small caps financials and even energy names, which have been struggling lately, are all experiencing a surge. It really begs the question, is the U.S. market becoming a bit too concentrated? Are investors overlooking potential opportunities in other parts of the world?
I think it's important to unpack those terms you just used. Red sweep refers to the fact that Republicans won control of both the House and the Senate in the recent U.S. midterm elections. This outcome has created a wave of optimism among investors who believe that Republican policies such as tax cuts and deregulation will boost corporate profits and fuel economic growth. This sentiment, combined with positive economic data coming out of the U.S., has created what some are calling Trump euphoria, a surge in market confidence, driven by the perception that the U.S. economy is on solid footing.
That definitely clarifies things. So are investors getting carried away by the hype, or is this surge in U.S. markets justified?
That's a tough question. The U.S. economy is undoubtedly strong, but there are also concerns about potential overvaluation in the market. Some experts worry that investors are overlooking potential risks such as rising inflation and interest rates, which could eventually lead to a market correction. On the flip side, those who are bullish on the U.S. point to factors like corporate tax cuts, strong consumer spending, and a robust labor market as signs that the good times will continue.
It sounds like investors need to proceed with caution, even amidst all this excitement. And speaking of caution, CNBC also reported on gold braces for worst month in over a year on Trump-driven sell-off. It seems gold, usually considered a safe haven asset, is taking a hit as the dollar strengthens. Is this a sign that investors are becoming less risk-averse?
It's certainly an interesting development. Typically, when investors are uncertain or worried about the economy, they tend to flock to safe haven assets like gold, which are seen as less volatile than stocks. However, the recent strength of the U.S. economy and the dollar seems to be making investors more comfortable with risk, leading them to shift their investments into assets like U.S. stocks, which have the potential for higher returns but also come with greater risk.
So it's almost like a pendulum, swinging between risk and safety depending on the economic climate. But what does this mean for investors who are specifically looking for stability in their portfolios?
Hmm.
If traditional safe havens like gold are losing their appeal, where should they turn?
That's a great question, and it leads us to another interesting article from Bloomberg. They've highlighted a rather surprising example of economic resilience in drugs, help Switzerland withstand pain from swings in the franc. The Swiss franc is known for its stability, but it's also been strengthening lately, which can make it difficult for Swiss companies to compete in the global market. However, their pharmaceutical industry, led by giants like Roche and Novartis, is helping them weather the storm.
That's a great point. It seems counterintuitive that a strong currency would be a problem, but I can see how it would make exports more expensive.
Exactly.
Hmm.
But in the case of Switzerland, their pharmaceutical industry is so strong and innovative that they're able to maintain their competitiveness, even with a strong currency.
So it's a reminder that there are always opportunities to be found, even in a volatile market. Maybe instead of just focusing on the overall market trends, we should also be looking at specific sectors and the companies leading the way. What makes a sector like pharmaceuticals so resilient? And are there other industries that might offer similar stability and growth potential?
That's a very astute observation. The Swiss pharmaceutical sector is a fascinating case study. What sets it apart is a combination of factors, including a long history of innovation, a strong focus on research and development, and a supportive regulatory environment. Companies like Roche and Novartis invest heavily in cutting-edge research and are constantly developing new drugs and therapies. This constant innovation allows them to stay ahead of the curve and remain competitive in the global market.
It's almost like a self-perpetuating cycle of success. The more they invest in research and innovation, the more competitive they become, which leads to more profits, which allows them to invest even more. It makes you wonder, are there other countries that could replicate this model? What lessons can we learn from Switzerland's success?
Those are excellent questions, and they highlight an important point. We shouldn't just be looking at market trends in isolation. We also need to understand the underlying factors driving those trends, whether it's technological innovation, government policies, or demographic shifts. By taking a deeper dive into those factors, we can gain a better understanding of where the opportunities and risks lie.
Now, before we move on to more global headlines, let's touch on something a little closer to home. Bloomberg had a piece titled, How to Act on Warren Buffett's Latest Lesson. Marin Talks Money. This article focuses on some timeless advice from Warren Buffett, the legendary investor and CEO of Berkshire Hathaway. But it's not about stock picks or market predictions. It's about something much more personal: inheritance and family dynamics.
Ah, yes. The Oracle of Omaha always has valuable insights to share. In this case, he's offering advice on how to handle inheritance in a way that minimizes family drama and ensures that wealth is passed down responsibly.
The article mentions this massive generational wealth transfer that's expected to happen in the UK over the next few decades, something like £7 trillion by 2050. It's a staggering amount of wealth, and it raises some important questions about how families can manage these transitions effectively.
Absolutely. And Buffett's advice is surprisingly simple, but incredibly profound. He suggests that families have open and honest conversations about inheritance early on, clarifying expectations, and ensuring that everyone is on the same page. This can help prevent misunderstandings, conflicts, and legal battles down the road, which can be especially damaging when large sums of money are involved.
It seems like such a basic concept, but you'd be surprised how many families avoid these conversations. It's almost like talking about money is a taboo subject, especially within families.
You're right. People often shy away from discussing finances, even with their closest relatives. But these conversations are crucial not just for avoiding conflict, but also for ensuring that wealth is managed responsibly and passed down in a way that benefits future generations.
I think that's a great point to keep in mind as we delve into the next batch of articles, which focus on the performance of U.S. markets in comparison to the rest of the world. We've already touched on the Trump euphoria and the surge in U.S. stocks, but is this outperformance sustainable, or are there overlooked investment opportunities in other parts of the world? That's something we'll explore in more detail when we come back after a quick break.
Welcome back, everyone. Before the break, we were discussing the impressive performance of U.S. markets. Now let's take a closer look at whether this trend is likely to continue or if there are better opportunities elsewhere. Bloomberg has an interesting report titled Wall Street Wins, once again, as S&P 500 index beats global stock gauges, and it really highlights this dominance of the U.S. market.
It seems like every time we turn around, the S&P 500 is hitting another record high. But is this sustainable, or are we headed for a correction? And what does this mean for investors who are looking to diversify their portfolios beyond U.S. borders?
Those are key questions to consider. While the U.S. market has certainly been on a tear, it's important to remember that markets are cyclical and no trend lasts forever. The article points out that some analysts are concerned about the concentration of investments in the U.S., particularly in the tech sector, which has been driving much of the recent growth.
Right, and we also have to consider the potential impact of rising interest rates and inflation, which could put a damper on economic growth and corporate profits.
Absolutely. The article from the Wall Street Journal titled Week Ahead for FX, Bonds, Jobs, ISM Data to Indicate Strength of U.S. Economy really underscores this point. It highlights several key economic indicators that investors will be watching closely in the coming week, including the U.S. jobs report and the ISM surveys on manufacturing and services activity.
So it's a bit of a waiting game right now. We need
Yeah.
to see how these economic indicators play out before we can make any definitive pronouncements about the future of the U.S. market.
Precisely. But while we're waiting, it's also a good time to consider potential opportunities in other parts of the world. Remember that CNBC piece we discussed earlier? Asia Markets Live. Tokyo CPI, South Korea industrial production. It highlighted some mixed signals coming out of Asia, with South Korea's industrial production contracting, while Tokyo's inflation is on the rise.
So it's not all sunshine and roses in Asia, but could there be some hidden gems there for savvy investors?
Potentially, Asia is a vast and diverse region, and while some economies are facing headwinds, others are experiencing strong growth. For example, India and Southeast Asia are often cited as regions with strong growth potential, and their markets may offer attractive opportunities for investors who are willing to look beyond the familiar territory of the U.S.
It's a reminder that diversification is key, not just in terms of asset classes, but also in terms of geography. Speaking of diversification, let's not forget that earlier in our deep dive we were talking about the Swiss economy and how their pharmaceutical industry is helping them navigate the challenges of a strong currency. It's almost like a case study in economic resilience.
It really is. That Bloomberg article, Drugs Help Switzerland Withstand Pain from Swings in the Franc, provided some great insights into what makes the Swiss pharmaceutical sector so successful. It's a combination of factors, including a long-standing culture of innovation, a supportive regulatory environment that encourages research and development, and a highly skilled workforce.
And those factors have allowed Swiss pharmaceutical giants like Roche and Novartis to become global leaders in their field, developing groundbreaking drugs and therapies that are in high demand worldwide. It makes you wonder, are there other countries or industries that could replicate this model of success?
It's certainly worth exploring. The Swiss model highlights the importance of investing in research and development, fostering a culture of innovation, and creating a supportive environment for businesses to thrive. These are principles that can be applied in a variety of contexts, and they may be particularly relevant for countries or industries that are looking to move up the value chain and compete on a global scale.
It's inspiring to see how a relatively small country like Switzerland can become a global powerhouse in a highly competitive industry. Now let's shift our focus to Europe, where things seem to be a bit more turbulent. Bloomberg has an article titled S&P Sticks with France, Rating in Reprieve for Prime Minister, that paints a rather unsettling picture of the political and economic situation in France.
Yes, it seems that France's Prime Minister Michel Barnier is facing some serious challenges. The article highlights the political turmoil surrounding his government's efforts to pass the 2025 budget, including a looming no-confidence vote and rising bond yields, which signal investor concern about the country's economic stability.
It sounds like France is walking a tightrope, trying to balance the need for economic reforms with political opposition and social unrest.
It's a delicate situation, and it's a reminder that political instability can have a significant impact on a country's economy and its standing in the global market. The article mentions that S&P, while maintaining France's credit rating for now, has issued a warning highlighting the risk associated with political uncertainty and its potential to derail the government's efforts to repair public finances.
So what does this mean for investors? Should they be concerned about the situation in France, or is this just a temporary blip on the radar?
It's certainly something to keep an eye on. France is a major player in the European economy, and its political and economic stability has implications for the entire Eurozone. If the situation deteriorates further, it could lead to broader market volatility and a loss of confidence in the euro.
This brings us back to that idea of diversification that we were discussing earlier.
Mm,
If investors are too heavily concentrated in any one market, whether it's the US, Europe, or Asia, they're more vulnerable to these kinds of shocks. Spreading investments across different regions, sectors, and asset classes can help mitigate the impact of unforeseen events.
exactly. Diversification is a key principle of risk management, and it's particularly important in today's globalized and interconnected world where events in one part of the world can quickly ripple through the global economy.
It's almost like a game of chess trying to anticipate the next move and position yourself accordingly. But with so many factors at play, it can be difficult to know which way to turn. Maybe we should take a step back and consider the bigger picture. Throughout this deep dive, we've been discussing a wide range of topics, from the transformative power of AI to the contrasting fortunes of different economies and the importance of personal financial planning. Are there any overarching themes or takeaways that stand out to you?
I think one of the key takeaways is that we're living in a time of unprecedented change and uncertainty. The global economy is in a constant state of flux, driven by technological advancements, geopolitical shifts, and demographic trends. This creates both opportunities and challenges for investors, and it requires a new way of thinking about risk diversification and long-term planning.
I agree. It's no longer enough to simply follow traditional investment strategies. We need to be more adaptable, more informed, and more willing to embrace new ideas and approaches.
Exactly. And that brings us back to a point we touched on earlier, the importance of staying informed. In a world that's constantly changing, knowledge is power. By keeping up with current events, understanding economic trends, and learning about new technologies and investment strategies, investors can empower themselves to make smarter decisions and navigate the complexities of the global market.
Well said. And speaking of staying informed, we still have a few more articles to explore, including one that delves into the age-old debate of active versus passive investing. We'll tackle that topic along with some other personal finance insights when we return after a short break. Welcome back, everyone. Before the break, we were talking about the need to stay informed in this ever-changing financial landscape. So let's dive into some articles that offer insights into personal finance and investment strategies. Maybe we can help our listeners make some smart decisions for their own portfolios.
Sounds good. You know that Bloomberg article we touched on earlier, How to Act on Warren Buffett's latest lesson? Marin Talks Money really digs into some practical advice that can be helpful for anyone, not just those inheriting millions.
Right. I remember it mentioned this huge generational wealth transfer happening in the UK, something like 7 trillion pounds by 2050, and how individuals should approach investing such a windfall.
It's a staggering amount of wealth, and the article raises the question of active versus passive investing in this context. Should you try to beat the market with carefully selected stocks or go with low-cost index funds that simply track the overall market performance?
The classic dilemma. I feel like every investor grapples with this at some point. What's the article's take on this debate?
Well, it suggests that the current market environment, with its heavy concentration in U.S. tech stocks and high valuations, might be a good time to consider active management, especially for those seeking diversification beyond the U.S. market.
That makes sense. We've been talking about how the U.S. market has been outperforming the rest of the world, but as you mentioned, no trend lasts forever. It would be wise to explore other opportunities and not have all your eggs in one basket, so to speak.
Exactly.
The article goes on to highlight some specific investment trusts in the UK that have outperformed their open-ended counterparts, suggesting that those could be worth exploring for investors seeking active management options.
So it's not just about choosing active or passive, it's about understanding the nuances within each category and finding what aligns with your goals and risk tolerance. I remember we discussed earlier how CNBC reported on gold braces for worst month in over a year on Trump-driven sell-off, and it seems like safe haven assets like gold are losing some appeal as investors become more comfortable with risk in the U.S. market. But what about those who prioritize stability above all else? Are there any options for them in this current climate?
That's where diversification comes in, both geographically and across asset classes. While U.S. stocks have been soaring, other markets are offering potentially undervalued opportunities. We talked about Asia earlier, and there are also emerging markets in Latin America, Africa, and even Eastern Europe that could provide a hedge against a potential downturn in the U.S. market.
It's a reminder that the world is a big place, and there are always opportunities out there if you know where to look. But it also sounds like it requires a lot of research and due diligence.
You're absolutely right. Investing in international markets can be complex, and it's crucial to understand the specific risks and opportunities associated with each region or country. Factors like political stability, currency fluctuations, and regulatory environments can all have a significant impact on investment returns.
So it's not just about chasing the highest returns. It's about finding a balance between risk and reward that aligns with your individual goals and circumstances. This brings us back to that Wall Street Journal article, week ahead for FX, bonds, jobs, ISM data to indicate strength of U.S. economy. It emphasized the importance of staying informed about economic data releases as they can provide valuable insights into the health of the economy and potential market movements.
Absolutely. Understanding key economic indicators like inflation, interest rates, and unemployment can help investors make more informed decisions about where to allocate their capital. The article highlighted some important data points coming out next week, including the U.S. jobs report and the ISM surveys on manufacturing and services activity. These reports can offer clues about the direction of the economy and potential policy changes from the Federal Reserve.
It sounds like investors will need to pay close attention to these data releases and interpret what they mean for their own portfolios. But even with all the data in the world, predicting the future is impossible. There will always be unexpected events and market swings that can throw even the most carefully laid plans off course.
That's where having a long-term perspective and a well-diversified portfolio becomes crucial. It's about riding out the inevitable ups and downs of the market and staying focused on your overall investment goals.
It's a bit like sailing a ship through stormy seas. You need to be prepared for rough weather and have a steady hand on the wheel. And speaking of stormy seas, we can't forget about the political risks that are lurking out there. Earlier, we discussed the political turmoil in France, which was highlighted in the Bloomberg article, S&P sticks with France, rating in reprieve for Prime Minister. It's a reminder that political events can have a significant impact on markets and economies.
You're right. Political risks are always present, and they can range from unexpected election results to policy changes, trade wars, and even geopolitical conflicts. These events can create uncertainty and volatility in the markets, making it difficult for investors to navigate.
So how can investors protect themselves from these political risks? Is it even possible to predict or mitigate them?
While it's impossible to predict every political event, staying informed about global affairs and understanding the potential impact of political risks on different asset classes can help investors make more informed decisions. Diversification is also key here. By spreading investments across different countries and regions, investors can reduce their exposure to any single political event or regime change.
It's about spreading the risk and not putting all your eggs in one basket. That seems to be a recurring theme throughout our deep dive today.
Yeah.
Whether we're talking about specific investments, asset allocation, or global markets, diversification is key to navigating the complexities and uncertainties of the financial world.
Couldn't agree more. Diversification, risk management, and a long-term perspective are essential for success in today's dynamic and ever-changing markets.
Well, I think that's a great note to end on. We've covered a lot of ground today, from the AI revolution in oil production to the political turmoil in France and the practicalities of personal finance. It's been a fascinating journey through the world of finance, and we hope our listeners have found these insights valuable.
It's been a pleasure sharing these insights with you and our listeners. We hope this deep dive has provided some food for thought and perhaps inspired some new ideas about how to approach investing and financial planning.
And remember, we'll be back tomorrow morning with new headlines from major financial magazines.
Until then, happy investing, everyone.